Hi everyone, welcome to a brand new episode. I'm Marcus. Today we're looking at Nike, ticker symbol NKE. We'll cover the income statement, balance sheet, cash flow, key figures, our key features, and the technical aspect of the stock. Should we be buying the stock right now? Let's find out. As I mentioned, we're looking at Nike, ticker symbol NKE, and they are traded on New York Stock Exchange and are in the manufacturing sector. If you go down to the screen, we can see that their market capitalization coming in at $226 billion and the revenues at $46 billion. Now, the PE ratio coming in at 37. I like companies with a PE ratio of 20 or below. So having 37, that is too high for me. So that is a no. But guys, I want you to let you know, when you see a stock with a high PE ratio, that tells you that the market expectation of that stock is high, and therefore there are a good chance that you might see capital gains on those stocks. But the overhanging risk here is that if the company doesn't meet those expectations, we will see the stock price fall. Same thing goes when you see a stock with a low PE ratio. That tells you that the market expectation of that stock is low, and therefore you might not see capital gains on those stocks. Just keep that in mind. Now, the profit margin coming in at 13%. I like companies with a profit margin of 15% or higher. So I understand 13% is not far from the threshold. You want to be flexible, but for my sake, the 13% is lower than what I'm looking for. So that is a no for me. Price to sales ratio coming in at 4.8. Normally, I like companies with a price to sales ratio of maximum 4. So 4.8, same thing here, is not far from the threshold. I know you want to be flexible, but for my sake, it's higher than what I normally like to take a look at. So that is a no for me. Price to book value coming in at 15. Normally, I like companies with a price to book value of maximum 3. So 15 is just too high for me. So that is a no. So if we were to summarize, PE ratio is too high, price to sales ratio is too high, and price to book value is also too high. This tells me that Nike at its current state is overvalued. Now, they pay a dividend of $1.13. I like that because I like those recurring incomes. So that is a plus. Effective return coming in at 0.81. That is way too low. So that is a no for me. I would like to see a range between 2.5-3%. That would be acceptable. So but 0.8, that is just too low. So that is a no. Return on equity coming in at 14%. Now, I like that, and that is a plus. Basically, return on equity tells you about a company's ability to create return on their equity. And as for an investor, you want to make sure you have a company with a positive return on equity, because that tells you that they are able to create a return on your capital you're about to invest in them. So 48%, I like that. Return on assets coming in at 12%. I like that. So that is also a plus. Now, the stock is currently traded at $142 per share. And if we go down to the moving average, we can see that we are below the 50-day moving average, but also below the 200-day moving average. This signal tells us that we might see the stock price decline. But let's take a quick glance at the chart, and we can see that we have been moving within a negative in a descending triangle before we saw a spike here, a big gap, and also that we saw a double top here, and also that now the stock is below that area. So this could be that we might see the stock price start moving further down. Further look at the technical aspect of the stock further down. But let's jump over to the income statement. And what we're interested in here is that the total revenue went from $34.5 billion in 2017 up to $44.7 billion in 2021, and the numbers have been improving every year. We fell off in 2020, but overall trend is positive. I like that. Gross profit went from $15.3 billion up to $20 billion, and the numbers have been improving. We fell off in 2020 as well, but overall trend is positive. I like that. Now, net income went from $4.2 billion up to $5.7 billion. We fell off one year, then we grew, and then fell off and grew again. So a bit of fluctuation here, but overall trend is positive. I like that. Now let's jump over to the balance sheet, and what we are interested in here is that the current assets versus the current liabilities, and we can see that there is a huge difference between the current assets and the current liabilities. Basically, if the company were to convert the current assets to cash, cash. They are able to pay off the current liabilities, which is a plus. I like that. But they are also able to pay off the total liabilities, which is amazing. Imagine being able to pay off your student loan, your credit card, your mortgage, all your debt, and still have capital left on the table. That is huge. I like that. Total liabilities went from 10.9 billion and grew to 25 billion, and the numbers have been growing every year. That is negative. I would like to see them start reducing the total liabilities. Outstanding share have not changed over the last 5 years. This is negative. Now, basically outstanding shares, when you see that the numbers are decreasing on the outstanding share, that means that there are fewer and fewer available shares, and also that your share of the companies is growing. But when you see that the numbers are increasing, that means that the companies issuing shares, also meaning that there are more and more available shares, meaning that your share of the company is decreasing. It's being diluted, and there's a lot of investors that either skip this part or doesn't know about it, because they've been looking at the balance sheet of the company and see a stock with a lot of assets, and the debt is not growing that much, which is great, which is positive. But on the other hand, we see companies issuing more and more shares, and that's a way for a company to bring in more capital without taking on more debt. So seeing that the numbers are unchanged, that is negative. Now let's jump over to the cash flow, and what we are interested here is that the operating cash flow versus the capital expenditure. And we can see that operating cash flow landed at 6.7 billion and the capital expenditure at 695 million, making it a difference of $6 billion. I like that. Operating cash flow went from 3.8 up to 6.7, and the numbers have improved. We fell off in 2020, but overall trend is positive. I like that. Capital expenditure more or less unchanged over the past 5 years. It fell off in 2021, but overall I like that. I like the fact that they continue to invest in the business. Now let's jump over to the key figures, and what we can see here is that the earnings per share went from $2.5 up to $3.6, and we fell off and then grew again, and then fell off and then grew again. So fluctuation, but overall trend is positive. I like that. Revenue per share went from $20.9 per share up to $28 per share, and the numbers have been improving every year. We fell off in 2020, but overall trend is positive. I like that. Equity per share went from $7.5 up to $8 per share, and then we fell off here a couple of years and then improved in 2021. Overall trend is negative. I don't like that. Dividend per share went from 69 cents up to $1, and the numbers have been improving every year. That is a plus, because I like those recurrent income, but also the fact that the income is growing. So that is a plus. I like that. Dividend per share, a bit of fluctuation. We see 26%, 64, 32, 33, 57, 28. I like this because I like a company that pays out less than 60% of the capital, because I want some of the capital to remain in the business for investments, acquisitions, and just overall strengthening the business for uncertainty. So this is a plus. I like that. Gross margin went from 44.4% up to 44.6%, and also not a lot of change over the last 5 years. These numbers are stable. I like that, but I would like to see that they become find ways to become more and more efficient. But we should be comparing this number across the industry and see how Nike is doing compared with the competitors. But gross margin, I like the numbers. They are stable. That is a plus. Operating margin, we can see went from 14% up to 14.9%, and we fell off and we improved, and we fell off and improved again. A bit of fluctuation, still positive. I don't like fluctuation because it makes it harder for you to determine the future, but seeing that overall trend is positive, I like that. Profit margin went from 12.3% up to 12.8%, and the numbers, we fell off again, improved, fell off, and then improved again. These numbers are a positive, still fluctuation. I don't like that, but overall trend is positive. Return on equity went from 34% up to 44.8%, and as I mentioned, return on equity tells you about a company's financial ability to create a return on their capital. So seeing that they went from 34 up to 44.8, and we can see that the numbers fell, we improved, and fell, and improved again, but overall trend is positive even though we have fluctuation. Return on asset went from 18% down to 15%, and we fell off, improved and fell off. So these numbers are negative. Even though we have fluctuation, but we can see the numbers are getting lower and lower. Solidity tells you about a company's financial strength for the long term, and we can see it went from 53% down to 33.8, and also that the numbers have been falling every year. We improved in 2021, but overall trend is negative. Balance sheet liquidity tells you about a company's financial strength for the short term, and we can see we went from 4.6 down to 2.1, and that the numbers have been falling. We improved 1 year, but overall trend is negative. Debt ratio went from 0.87 up to 1.96, and then we can see the numbers have been improving, have been growing every year, and then it fell off a bit in 2021. This is negative. Debt ratio telling you at in 2021 a debt ratio 1.9, meaning that they had 1.9 times more debt than equity in the business, and seeing that these numbers have been growing every year, that is negative. So that is a minus. Now guys, we have gone through the income statement, balance sheet, cash flow, the key figures. Now over to the key feature, which is our stock analyzer. And what it does is that it gives you a simplified, holistic overview of the company's performance. If you want to dig through the numbers, you can dig through the numbers or have the software do the heavy lifting for you. If we look at the screen, we can see that the PE ratio is above 20, which is negative. They pay out a dividend, which is a plus, and the dividend payout shares is less than 60%, which is a plus. The dividends have increased over the past 5 years, that is a plus, and the numbers of outstanding shares is more or less unchanged. This is negative, not a plus. I need to change that, report that. Revenue have increased over the past 5 years, that is a plus, and profit margin below 15%, negative. Profit increased over the past 5 years, that is a plus. Current assets is greater than the current liabilities, that is a plus. And solidity decreased over the past 5 years, negative. Balance sheet liquidity decreased over the past 5 years, negative. And the debt equity ratio increased over the past 5 years, negative. And the total liabilities have grown for the past 5 years, that is negative. Guys, as you can tell, it gives you a simplified, holistic overview of the company's performance, and it saves you a lot of time. If you want to dig through the numbers, you can dig through the numbers or have it do the heavy lifting for you. You can have this software along with everything we've gone through, plus access to our discussion forum where you'll be able to chat with me along with other members for only $10 per month. So make sure to head over to comus.se and become a member today. Okay? Thank you. But now let's jump over to the technical aspect of the stock. So here we have the chart. We can see that we have been moving within a positive trend line for quite some time. For quite some time, we can see here we have a small counter trend before the huge gap over here. Whenever you see a gap, just keep in mind that that gap will need to be filled again. So if you see something like this, just know that this gap will need to be filled up again. So you will see further down something like that, so meaning that the gap have now been filled. So this is what we could see further down, that the price moved back down below here, something we are seeing right now, that the price is moving down, and we could see that the moving average is signaling that we might see the price decline. But we could also see here that we had a double top here, and also a confirmation that we are below that line. So we could see the price starting decline. And what everything that goes on in the market right now, for me personally, what I would do is just stay away and just until April, May, and see the stock market reposition itself, and then take a stand on that when that time comes. But if we look at the chart, we can see that we are forming a ascending triangle right here. So we could see the price break up within that channel and then move higher levels and back into the positive trend channel. I think we'll see something like that, because this is a great company with a lot of things going on. Still, they have some challenges, and the challenges I see is that it's currently overvalued. The PE ratio, the price to sales ratio, and the price to book value is all indicating that the company is overvalued. And it is a shame that the financial, looking at the solidity, the balance sheet, liquidity, and the debt ratio, is not doing that well. But overall, they are paying out a dividend, and the dividend payout is less than 60% and above 20%, meaning that they have capital left in the business to do acquisitions, investments, and just overall strengthen the business. And I also like the fact that the revenue is growing and the profit also is growing and improving, and also the fact that they are able to pay off both the current liabilities and the total liabilities. So I like this stock, and I think for me personally, there is a good opportunity here to get in and buy this stock and just earn those dividends, and also a potential capital gains as the market reposition itself and we can see a new highs. So that is what I expect to see. But as always, I want you guys to do your own analysis and come up to your own conclusions. And also, if I can be of any service to you, please let me know if you have any questions for me to answer, and stocks you want me to take a look at. Just leave that in the comment section below and I'll reply to you. And as always, guys, I truly hope you enjoyed this episode. Please give me a thumbs up, comment, subscribe, and let me know what you think. And until next time, guys, take care. Bye bye.